The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Very warm welcome to Scorebox Europe. I'm Steve Sedgwick, and these are your headlines. ECB governors tell CNBC the European economy is on the right growth track and hail the progress in their inflation fight, but they remain split on how they interpret potential risks ahead.
I do not see any reason changing anything if there is not something new coming, and I do not see where it might come from.
As we are in a good position, we'll see. But if there is a next move, I think a rate cut is more likely than a rate hike.
The US Treasury Secretary Scott Bessent tells CNBC the White House will act in America's best interests as President Trump reignites the trade war with China. Bessent insisting reaction in the market won't impact US decision making.
We won't negotiate because the stock market's going down. We will negotiate because we are doing what is best economically for the US.
And Nestlé posting better than expected sales growth in the third quarter. Investors awaiting details on the new CEO Philippe Navratil's strategy. Plus, TSMC booking a near 40% rise in third quarter net profit, beating estimates. The world's largest contract chip maker riding the wave of AI investments. Right, there's plenty going on at the moment, including a raft. By the way, good morning to you all. Hope you're all feeling very well. I'm loving these markets at the moment. A lot going on. I noticed a few of you have been buying a bit of volatility as well, with the VIX above 20. There's a change from all of you. Anyway, look, GDP output for August. I'll read these numbers as I see them because you're getting them the same time I do. 1.3% year-on-year increase. That is in line with expectations. Up 0.3% a month, 3 month on 3 month. That is in line with expectations. Industrial output doesn't get any better, in line with expectations, down 0.7 of 1%. A minor improvement in the negative figure in August manufacturing compared to expectations. Reuters poll was for down 1%. It is down 0.8% year on year. But services output, flat as a proverbial pancake, 0.0% month on month. Right, okay, so I'm going to try and look for some data which is a little bit out of what you expected. And this is interesting. August manufacturing output better than expected by a decent margin, 0.7%, up versus 0.2% month on month. There's a lot of data there. I would suggest to you that they're either in line or mildly better than expectations in the whole. Services, in line with expectations. But by and large, the manufacturing component of the UK economy looks slightly better than expected previously. And even on the trade balance figures, they've come out as well. I might as well tell you those. They're kind of in line with expectations. EU August non-EU goods traded, negative 8.24 billion sterling versus revised negative 8.8 billion in July. What's the pound doing? Very little, as I say. These numbers look very much in line with expectations. But that aside, what are you all looking at the moment? And the answer is just a little bit of everything as well. We've got all the components that we've already discussed ad infinitum, conspiring to create what yesterday? Well, actually, yesterday, the markets kind of, and we'll come to this in a bit more detail, kind of had a bit of a pause in the United States as well. You've got all these components. You've got great figures coming out from the US banks, and Morgan Stanley, another really strong set of earnings on the trading front from one of the Wall Street giants there as well. We've got a lot of commentary, and I'll come to that in a moment, on central banks as well. The AI trade taking a bit of pause. What else have we got? Geopolitics, French politics, and concern about rates. A lot of that just on the back foot in this session. People just having a little bit of think where to go next, apart from in gold. And your gold trade continues to go up, everybody. I hope you're convinced that you're right in buying gold, up 60% so far this year. So we are continuing to hear from many ECB officials this week at the IMF and World Bank annual meetings in Washington, D.C. after the president of the ECB, Christine Lagarde, told CNBC the job of a central banker is never done. bit like an anchor, really. Karen has been sitting down with the great and the good, and she sat down with the Bundesbank president, Joachim Nagel. It was a terrific interview, loads of headlines there. Asked him how he sees the rate path from here.
It's too early to give any indication what is coming next. What I see is that we are close to our target. So the latest number from September is 2.2%. So it's close to our 2% target. I do not see any reason changing anything if there is not something new coming, and I do not see where it might come from.
That 2.2% that you cite on inflation was still the first time we've seen above 2% since April. And if you look at the services side, also still above 3%. Is there an inflation problem still for the ECB to tackle?
I think you said it rightly. I think the service inflation is still pretty high, so it seems to be very sticky. And this is giving me an indication that we shouldn't be complacent, so we have to keep our vigilant stance. And again, we did it right by cutting 8 times. We hiked 10 times before. Now we are close to our target. We have our next meeting by the end of this month. So the information that I see, at least for the moment, giving me not enough arguments changing anything. The course of the monetary policy that we found is the right one, this meeting-to-meeting approach.
How disruptive could tariffs still be from here? Namely, the US and China are still at loggerheads on getting to a trade position, because many of us had discussed the potential for tariffs in Europe to bring lower prices. First up, the goods coming through into Europe, but also in terms of any demand destruction. So do you see tariffs having any impact?
I think over the last 10 months, we were confronted with so many uncertainties. And the tariff discussion and the decisions around tariffs, this is one of these uncertainties. So at the end, I believe this whole situation is not helpful to the economy and how we try to evaluate what is of importance, especially when it comes to monetary policy. And yes, this is producing a lot of, let me say, it's producing a lot of uncertainty. So the whole tariff discussion between China and the United States, what was the, and again, coming back to the discussion we had around the tariffs discussion between Europe and maybe also here the United States, I do not see where are the winners for all this. It looks like to me that it's a lose-lose situation for really everyone.
And Karen also spoke to the Bank of France Governor François Villeroy de Galhau, who said that if there is to be another move, you heard it in the headlines, it would more likely be a cut than a hike.
We are in a good position, as Christine Lagarde stressed. We are 2 and 2, more or less 2% inflation, which is our target, and 2% interest rates. But a good position is not a fixed position, and we must follow what I call agile pragmatism. Pragmatism, we look at data, including the outlook. And if I look at the outlook, I think the risks on inflation are more tilted to the downside for several reasons. There is some increase of Chinese imports, quite significant, plus 10% in the last 4 months compared with last year, which is disinflationary, and this is trade diversion after the protectionist measures in the US. There is the exchange rate, and there are other technical factors. And on the upside, there are little risk, especially after the trade agreement with the US, because the EU did not retaliate. So it means that if, I stress the if, Karen, if, as we are in a good position, we'll see. But if there is a next move, I think a rate cut is more likely than a rate hike.
There's still sticky parts in the inflation basket, namely around services, 3.2% recently. Is that just a hangover from the post-COVID era? Will it naturally correct, or do you still see a stubborn challenge there?
No, when I look at services inflation, traditionally it's a bit higher than the inflation on goods, because it benefits less of productivity gains and global trade. But services inflation is decreasing significantly, and wage moderation, which is a key driver of services inflation, wage moderation is there. Let me stress, especially in my country, France, where we have a lower service inflation and a remarkable wage moderation.
Fellow Governing Council member Pierre Wunsch told Karen he had some concerns over the strength of the recovery in Europe.
We're essentially a target, and then it becomes a discussion about the balance of risk. I would say that the risks are broadly balanced, and I don't see major risk on the upside or downside. If I would have to choose, I probably would say that I see a bit more risk on the downside because of a strong euro, cheap Chinese imports, and an economy that's still weak. I mean, for the first time, we had an upgrade in growth, but there's a lot to do with the Q1 numbers. So, you know, it's growing, but it's not a strong recovery, that's for sure.
Unpicking the risk to the downside, you mentioned the Chinese imports. This is a direct consequence of the tariffs?
It is, to some extent, yes, a direct consequence of the redirecting of Chinese export away from the US. Actually, to the rest of the world. It's not unique to Europe. We see that also in the rest of the world, yes.
Now, you mentioned the strength of the euro. Some of that may be due to the impact we've seen of the lessening of the US dollar as a potential reserve currency. All sorts of attacks on the independence of the US Federal Reserve, concerns about the US fiscal position. If the euro were to continue to appreciate versus the US dollar, what would the impact be?
So first, I guess the prevailing narrative today is that people had a lot of unhedged position in dollars. They would invest in the US economy and get typically a higher return with an appreciation of the dollar. With the losses in the exchange rate front, they typically now hedge more. So if it's a one-off, okay. If it's structural, then of course it might unfold for a longer period.
What's your view?
Would we react?
Which is it?
You know, we'll just look at what the impact might be on inflation and then react to that as much as we would react to any thing that would impact inflation on the downside.
Is there a potential that you see inflation to the downside because of the strength of the euro?
It's one of the reasons why, if really I have to make a choice, I probably would say that the risks are a bit more on the downside. But again, we are, close to target, broadly balanced. So, I mean, of course, the question is whether we're going to cut again. I would see that the probability that we would cut again has been receding over the last few weeks or months.
There you go, a triumvirate of ECB policymakers. And our coverage continues from DC with new Austrian Central Bank Governor and ECB Governing Council member Martin Kochler. Don't miss that interview on the CNBC International live YouTube page. It's a long description. Shall I try again? Don't miss that interview on the CNBC International live YouTube page at 13:50 London time. Right, Jens, God, what's going on? Jens Eisenschmidt has joined us now. He's Chief European Economist at Morgan Stanley. And Jens, I know you've been sitting by for a long time because I saw you getting hooked up about 15 minutes ago. So thank you very much indeed for that as well. Look, I can't help but thinking it's very interesting listening to those policymakers, but you think perhaps the market and indeed perhaps what the policymakers are saying with their public protestations, they're underplaying just how many rate cuts we're going to have from here.
Yeah, I mean, good morning, first of all, and it was for me very interesting too to listen to these voices. I think, first of all, it would have been surprising to hear any change in the way they framed the policy problem, so the risk assessment relative to September, simply because there is not that much new information that has arrived. And I think it's a fair assessment, a good assessment, and I think that flows out of what most have said, that in October, in the October meeting, you wouldn't expect any change. So they're really actually waiting for the next projections. At the same time, there is clearly, and everybody has made allusion to that, a risk assessment story going on. And so it's really about what you think is the risk that's most important here and is going to play out. And we have simply a forecast of more rate cuts to come, because we believe the risks are materializing to the downside, much to the point of the French governor. But again, they are not really in the business to make as far away forecasts than we. So I mean, if you just take the ECB forecast at face value, they have inflation below target next year, yes, but then it goes back to target, and that's on the basis of more or less the current policy rate. So that then leads to a situation where they say, look, let's not change here anything in the communication until we see information arriving that changes that forecast. And that, for instance, is our expectation. We get more weakness, we get more appreciation in the euro, and that will lead to a forecast in December that is materially lower in terms of inflation, in particular in 27, and that should then lead to a cut.
Yeah, and can I ask just a very basic question that I guess a lot of people are asking at here? We've had rate cuts from the ECB and it's barely touched the sides on the economic growth projections. I know the IMF is getting all excited because we may well grow at 1.2% in 2025 as opposed to the previous 1%. It's pretty meagre fare, isn't it, as well? A really basic question for you. What does Europe need to do in addition to having low or lower rates in order to get its growth trajectory back on track?
No, I think you're touching here a very relevant and important point also for the conversation of policymakers. I think if you talk to rate setters or in general to monetary policy makers, they would probably tell you, I mean, we did our job. Inflation is under control. We are at target. Whatever we do now from here is really fine-tuning. But the real big fish to fry is really on the policy front on the other side, say reforms. To some extent, fiscal policy is actually what's the order of the day, to the extent that's possible. If you take the German case, you have the trade frictions that lead to a fall or less external demand than previously or than without these frictions. And so you supplement or complement the missing demand with internal demand, which is the fiscal policy. It's textbook policy. Probably monetary policymakers would tell you, well, you have to do this. Plus, you have to make sure that you're competitive in your economy. Just take the German economy again. There's a significant reform agenda that the current government is at the moment. I think that's needed. It's all centered around the cost of the factor labor. It's all centered around getting back to a competitiveness position that maybe the German economy had 20 years ago.
But I mean, I've almost got two questions here, so I'll just stick with one as well. We don't have the fiscal wiggle room. Yes, the Germans do, no doubt about it. But as a bloc, the Eurozone debt to GDP, and correct me if I'm wrong on this, Jens, is touching 90%, and we'll probably tip over that with the new German spending programs as well. That's not a lot of wiggle room, or is it?
No, I think that's absolutely right. That's exactly the challenge. So it's always easier to spend than to go on about reforms that may be painful. And that is essentially the order of the day in almost any other country. And even for the Germans, it's not just spend whatever. It is indeed a mix that is exemplified by the discussion on the 2027 budget, which has a gap, even with all that new borrowing that is opening and that actually needs reforms here. So indeed, it's a mix. And you can see that, again, if you sort of look at countries like France, where this is the debate for the ongoing debates at more than a year, how to consolidate, what's the way forward for the economy. Ultimately, of course, if you enact reforms that then get you more growth, that also in part solves the problem of the debt. It's all about growth in the end, the agenda, or has to be. And fiscal spending, I think in the case of Germany, yes, that's, I would say, here clearly justified by a shortfall of external demand. Other countries are not as trade dependent. So if you take France, for instance, or even the UK, these countries are not as trade dependent and so have much less of a reason to go big fiscal. Sorry, yeah.
Yeah, no, don't apologise. I'm rushing you. Jens, I'm showing on the screen now, any second now, the OATs and the yield curve, as if by magic. Thank you, Brittany. 3.3477 is where the 10-year OATs are. You could be forgiven for thinking that they had a beautiful fiscal position and they didn't have a budgetary problem and they had a government that lasted longer than 10 minutes, certainly compared with the UK 10-year gilts as well. But all of that isn't the case. They do have tenuous political situation, a horrible fiscal position as well, and no chance of a budget that's actually going to bring through meaningful reforms to get us down to 3% stability and growth pact levels as well. Why is everybody so sanguine and relaxed in bond world about France?
I mean, first of all, I wouldn't say everybody is relaxed in our conversations. I mean, if you just also look at the relative positions, I mean, spreads have widened to the bonds over the last, I would say, in locksteps, sort of with these attempts to try to rein into the deficit and the attempts not being as successful over the past years. French spreads have widened. And I think that's for sure. I mean, so that's not a level discussion. It's more like how far away are you from, say, the benchmark at that, which is bonds. That's number one. Number two, all of our conversations we have with clients suggest that many expect actually if this is not change that fiscal situation. So if there's not a change in course and primary surpluses start to materialize, then this spread widening, many investors that we talk to expect to continue. So from that perspective, not all is fine. And I think that's also where we get the consolidation push from, that internally would say, okay, we need to now, at least looking forward, going in the future, see that we stabilize the debt at the level that it is currently, for which you need primary surpluses.
Jens, thoroughly enjoyed the interview. Thank you so much indeed for joining us today. Jens Eisenschmidt, who's Chief European Economist at Morgan Stanley. Morgan Stanley had a very good day yesterday, didn't they, as well? But I won't ask you about that. I'm not allowed. Right, OK, thanks, Jens. I'll get in all kinds of trouble there. Ritika, get me out of trouble. Morgan Stanley, big catalyst to the upside. But net markets flattish?
Yeah, you know what, Steve? It did actually give a boost to those markets because we had yesterday in the US another volatile trading session. But as you mentioned there, it was another set of strong bank earnings. It was another AI deal that helped the S&P 500 close into the green. You can see there closing out the session up 0.4%. The NASDAQ having even stronger gains, closing up nearly 0.7%. Steve, it seems to be this tug of war between optimism but also caution over those US-China trade tension. And speaking of, let's flip up the board, take a look at the Asian session, where we're seeing actually a mixed picture when it comes to stocks. You can see the Hang Seng down some 0.4% there. Again, those US-China tensions. Now, President Trump says he still will meet with President Xi later this month. This is as the Treasury Secretary Scott Bessent has suggested a longer pause on those tariffs. Let's flip up the board and take a look at how the European market is shaping up. And we're actually seeing now a mixed picture here. FTSE down 0.2%. Of course, you just mentioned that GDP figure coming out of the economy in the UK, growing 0.1% in the month of August, as expected. We'll also be focusing on all those corporate earnings filtering through today, that from Nestlé to KitKat, as we get a tell on the consumer, to ABB, and of course Pernod Ricard as well. Finally, let's see how the US market is shaping up. You can see there we're inching in to the green there, holding on to some of those gains. But you know what, Steve? It's been so volatile that who knows if those gains will actually hold.
Thank you very much indeed for that, Ritika. Right, President Trump says the US is in a trade war with China. You kind of almost feel make your mind up, sir, don't you? Anyway, is in a trade war with China, adding that if he hadn't imposed a 100% tariff on Beijing, America would be exposed as being a nothing. Okay. It comes amid a spike in tensions between the countries in recent weeks, with the US imposing levies on Chinese ships in its ports, whilst China has clamped down on export controls for rare earths. Treasury Secretary Scott Bessent has raised the possibility of extending a pause on import duties on Chinese goods beyond the current 3-month window if China halts its rare earth export control. And as you can see, market's really very, very relaxed about all of it at the moment. Now, the Treasury Secretary has also rejected suggestions the US will change its negotiating stance with China should there be stock market volatility, which there isn't really at the moment, although I noticed the VIX is up to 20%, or 20 level, I should say. He was reacting to a report in the Wall Street Journal which suggested Beijing expects the prospect of a downturn in markets would force the US president to the negotiating table. Speaking to CNBC, Mr. Bessent insisted they will negotiate because it is best economically for the United States. Speaking at CNBC's Invest in America forum, Bessent stressed that both parties have leverage over the other.
Part of this investment boom that we're seeing is President Trump wanted to reshore, and part of the reshoring is strategic. So we don't want to decouple with China. I don't believe they want to decouple, but this rare earth export control is a sign of decoupling.
But we need them, don't we?
Sorry?
We need those rare earth minerals, don't we?
We do.
I mean, that's leverage that they have on us.
But we have lots of leverage on them, too.
Great exchange there with Sarah Eisen. Right, coming up on the show, Nestlé shares rise in pre-market trade as the consumer giant's new CEO unveils his strategy. We'll break it down. Plus, defence spending is in focus, with the EU set to unveil its strategy later today. We'll hear from some of Europe's key stakeholders on the complicated path forward. And Swedish private equity giant EQT has posted its latest results. We're going to hear from the CEO, Per Fransson, 09:45 London time. TSMC, there's a flash on the screen here. It says AI demand continues to be very strong. Stronger than we thought only 3 months ago. Isn't that interesting? Third quarter profit at TSMC jumped 39%, beating market expectations. The Taiwanese contract chip maker, whose largest customers include Nvidia and Apple, benefited from strong demand for AI chips. Arjun, can I ask another stupid question or a basic question? Is TSMC now as much a play on AI as a lot of other tech names have become, or is it about the commoditized business elsewhere? Or I presume the answer is a bit of both.
I think a bit of both. Yeah, look, the AI story is certainly driving TSMC, and I think it is driving a lot of the success it's been seeing over the past couple of years. I think also what's critical with TSMC is it's been able to cement itself very strongly ahead of any other competitor. So when we talk about moats, Intel has been struggling over the past few years. Samsung hasn't been able to scale the way TSMC has, and that leaves TSMC with the bulk of these what we call these leading edge chips. So these are 7 nanometer and below. These are the chips that Apple wants TSMC to make. Nvidia, AMD, all the big players here. And I think the earnings were very, very interesting and very strong. And there are a few bits just to unpack here. Firstly, the guidance. They upped their guidance for the year. They said the forecast for 2025 now is for revenue to increase close to mid 30%. Before it was around 30%. They also raised their capex. And again, when we think about the long tail of the supply chain, it could be good news for them. So they're saying now 2025 capex to be between 40 and 42 billion US dollars versus 38 to 42 previously. And again, we're thinking about companies like ASML and all of these other companies that contribute to manufacturing. This is probably good news for them. Then on some of the expansion plans on Arizona, they were saying they're speeding up the capacity expansion there, and they're close to securing a second large plot of land for further expansion into Arizona. Now, just back to that AI story. Look, it is AI that is really driving a lot of this. You mentioned the way the company's talking about AI. 57% of their revenue in the quarter was due to high performance computing, which is effectively where they book revenue from companies like Nvidia and also from companies like AMD as well. The 5 nanometer chips production, that is 37% of their revenue. Again, this is where mostly where Nvidia and AMD are playing at this point in time. And you're seeing smartphones remain strong as well.
I have so many questions. I can only ask one. Rod will only let me have one, so I'll do this. Why is, in a world of crazy valuations, TSMC only trading at 20 times forward?
It's a great question. I asked myself that this morning. I don't have an answer.
No, look, the shares have had an enormous rally.
Yeah.
Let us not kid ourselves. Back in 2022, they were 389. They're now trading 14.85 Taiwanese.
Yeah. And I think partly is the fact that they've continued to raise. I think beat and raise over the last couple of years, and that's helped to keep that, I guess, forward P kind of somewhat under check. But there is still, I think, key when we talk about the chip industry. As I said, TSMC is moving very, very quickly. I think what's going to be interesting is where does Intel fit into all of this going forward? Are these investments we're seeing into Intel and some of the more sort of bullish thoughts about Intel going to come true? And one of Intel's issues has not necessarily been lack of investment. It's been a lack of ability to catch up from a technology position. And will this new investment into Intel be able to allow them to catch up with TSMC? That's a big question.
Do you know, on a forward PE, maybe it's the wrong measure, I don't know. Tesla trades on 207 times, Palantir 221 times, TSMC 20 times. No one else think that's interesting?
It's boring, isn't it? Picks and shovels.
Oh, it's certainly not boring.
It's not boring.
Thank you very much indeed for that, sir.